Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. We are back on December 13th. We are sitting here at 10 a.m. Central Time. And how's it going, Zane?
Good. Friday the 13th. What fun.
Yeah, see if we get any scary news. I think that's what they say about Friday the 13th, but don't know if that's a December thing. But this week, as we promised last week on Friday's recording, talked a little bit about the situations going on in Syria. So I think that's maybe a good place to kind of start up again and give a little recap. So as we mentioned, things were moving pretty quickly. There was kind of that 2-week change where just everything with all the opposition forces kind of began their 2 different operations and moved in. And on Sunday, they had overthrown the Assad regime. And so kind of just some quick highlights. I think we'll keep it high level. Is just still very much an evolving situation with HTS, who is kind of the lead force within the opposition forces. And they have started to centralize power in Damascus. So there's a little bit of unknowns there, I think, with all of the different kind of religious groups that are in Syria, very diverse population, and definitely some very diverse power groups in there. You have Turkey, you have Iraq, you have US, you have Russia, quite a few people, quite a few players. So, don't need to dig in too much to that one. But I think that is one maybe that I'm watching for indications of what might happen between, say, Iraq and Kurdistan with the ongoing pipeline export dispute. I think that's maybe just something that could give the KRG some more leverage in negotiations. So I think really that's the only takeaway that I'll point out now. I think there's quite a few things that we can talk about with Russia, Venezuela, and some of these others. But, I think we can let more information come out to get some clarity. And so,
yeah, I mean, the one thing that I'll add that maybe is just, I don't know, a magnifier on what is already out there. So in general, the U.S. and Russia at conflict over Ukraine. We've been the primary financial backer of Zelensky, and not to say that European powers have not stepped up to fund the war machine as well. But it's just interesting how this now moves to Syria, where it's been, I don't know, I guess almost a decade since we've been in a position to have an interest in Syria, at least in the way we do as of the last 10 days, 2 weeks. And is that, now the U.S. and Russia are at odds on 2 fronts. So I think those 2 countries, like when you bring that out or bring that up, like the laundry list, I think those are the 2, I guess, competing forces. The Iraqs versus the Kurds, internal. How does this regime change impact the relationship between the IOC and the group that controls the northern Iraqi flow of crude? And then the Russia-U.S. standoff was certainly with a new administration coming in, and what's transpiring in Syria. Does it escalate tensions between the U.S. and Russia? Is the new executive branch in the U.S., coming in to cool things off? The rhetoric versus the reality, I guess, as you said, is we're watching. I don't have any clear takeaway from it. Yeah,
it's definitely been interesting. Just, quick one on the Trump side of it. I think he's been pretty outspoken. This is not the U.S.'s battle to go in and be super active in Syria. Meanwhile, I think the Biden administration has kind of been on the fence, still mulling what they're going to do about the HTS, currently designated as a terrorist group. It spun off from Al-Qaeda in 2011. Publicly kind of broke those ties in 2016. But when you look into the background of HTS, there's a lot to maybe pause and just kind of question what the current narrative is about, how welcoming they will be to different groups in Syria versus how they kind of acted when they were in power in their kind of little pocket of Syria. So definitely some questions there. But I think that just the Middle East focus kind of gives us an opportunity to dig into OPEC's report this week, the MOMER, which I think we promised last week we had discussed too. So kind of high level, lowered 2024 and 2025 demand growth forecasts. 2024's was cut to 1.61 million barrels per day year over year of demand growth versus the July forecast that OPEC had for plus 2.25 million barrels per day. But I think that kind of headline number that is widely circulated needs some context from kind of where those revisions are taking place and what actually is happening on the numbers that they're adjusting.
Yeah, I mean, so when you look at the quarterly breakdown, the way that OPEC issues their demand forecasts, the good old US of A gives you a monthly breakout, and OPEC just provides it by quarter. So did any independent quarter take the brunt of the change? The answer is yes. Q3 of 2024 and just the December monthly oil market report versus the November was revised down 500,000 barrels a day. Quite the chunky cut. Now, keep in mind that that is a period that is in the past. In November, one would think that the best estimate of what actually happened would not change materially. And yet, here we are, Q3 of 2024 revised down 500,000 barrels. An even larger change for Q3 2025, down 0.7 or 700,000 barrels per day. So both of those fall in this rather muted change. You know, next in line would be Q2, where both 24 and 25 saw a 200,000 barrel per day haircut. You know, those are meaningful changes right there in the middle of the year. We still find it pretty fascinating how Q4 of 2024 is, for the most part, just kind of held steady, really going back all the way to November of 23, right around 105.5 million barrels per day of global demand. And, you know, I think that this trend, you know, something that we've highlighted a few times in our daily reports, and I think we've probably even brought up on the podcast before, this how Q4 of 24 stands out as this, don't touch that one. We're leaving that one alone. And we'll get to some global inventory levels here in a bit. And I think the question mark that's out there is, are we going to move another, 3 months forward in time when theoretically OPEC will finally start bringing the barrels back online? I laugh because, 1 month delay, 2 month delay, 3 month delay. I guess if we're going, a linear extrapolation, does that mean we're going to get a half year change next? I guess we shall see. But do we get out a quarter in time and is now Q4 of 24? Does it get the same downward revision that you've just seen from Q3?
Yeah, I think.
Yeah, I think
the demand growth forecast for OPEC coming down. You have the IEA kind of notoriously bearish on 2024's demand growth, but in their latest update to IEA growth forecast, they increased 2025 to, I believe it is 1.1 million barrels per day. So it's kind of an interesting dialogue between those two, but I think this kind of continued revision, a lot of the headline narratives are saying, this is just kind of reinforcing this bearish demand. We don't have anything coming out of China. We don't have, or I guess, India is a little bit underwhelming, kind of insert your growth center, and it's not what we wanted it to be. But as you mentioned, kind of getting that into this inventory dialogue, you have global inventories falling to historically low levels, kind of related to these production cuts. But it's kind of been ignored a little bit, kind of allowed to feed into this. I guess it's passed by relatively unnoticed. And it kind of opens this interesting question of, okay, so what if OPEC, as you mentioned, gets to this Q1 of 2025 and they say, okay, I think we're going to just hold off on bringing this production back online. And, at what point do these global inventories get to problematic levels? So I guess just to give a quick overview of where we are, say in the U.S., we're at the lowest in 10 years, which, I think you'll be able to add some color onto that one. We have Cushing at the lowest seasonally since 2008. And then products for the U.S., we have gasoline at the second lowest since 2015. Distillates are at a 3-year seasonal high, but still well below the 5-year and 10-year kind of averages. And Europe also, until kind of the beginning of December, was near this kind of energy crisis, BTU crisis level. And I think that's kind of the theme, is we're kind of tracking alongside that BTU crisis level. But I think, maybe offer some thoughts onto that.
Yeah. I mean, I think that point is that you just made about being near pre-BTU crisis level, so think 2021, early 22 is really important. Like what would happen if demand somewhere began to change course and the market was surprised. I mean, I say it laughingly in that it was a pretty consistent, regularly scheduled process of downward demand revisions. So, at some point, could that go the other way with inventory levels where they are? The ignoring point that you just brought up, I think it is really interesting that the market is shrugging off the inventory levels. We talked about this earlier this week in one of our daily market reports, how the OPEC demand forecast didn't really seem to be a weight on the market. And, was the crude trading community looking at that and saying, well, I saw the decrease in supply for 25, meaning the pushing out of the return, and that was greater than the demand reduction. So actually net positive maybe, while at the same time still kind of ignoring the inventory setup. Just a little bit of context on the 10-year lows for crude inventory. So yes, and it wasn't that long ago that we were at this just over 420 million barrels in the U.S. sort of inventory level. And in fact, that was at the, call it the end of the BTU crisis, early December 2022. I think that Cushing number that you mentioned and the seasonal or early December lows going back all the way to 2008, Cushing is one of those funny things, is like, what's the relevance of Cushing? There's even been discussions about whether or not Cushing should be the benchmark location. I mean, that is, I don't know. It's fascinating when people talk about the relocating of a benchmark, from Cushing to Houston, let's say, where all the exports occur. Same discussion's been had about Henry Hub. I'll stick my neck on the chopping block and say that's a virtual impossibility to ever move them, because what would you do with all of the derivative contracts that face these locations to all of a sudden then just port them over to somewhere else? So that color to say that Cushing being where it is, often Cushing won't matter until it does, meaning, nobody's paying attention. Whoa.
Yeah.
If there's that little there and it's the benchmark hub, maybe we should be higher. And lo and behold, here we are. We've poked our head back over 70 at the front of the crude curve a couple days in a row over that mark, which had proved to be resistance really for the better part of the last month. And, just before Thanksgiving, there were a couple daily closes with the front month TI contract over 70, but that was really it until the last couple of days. So, being back over that, and, I guess, the next several days with these comments on inventory, does 70 become support? I mean, it's like watching paint dry. We've really been in a really tight range again. It feels like the crude market is, gone from the 75, 80 tightly range bound until it was time to make a big chunky drop down into 70 to 75. And then now we've done the same thing, is it 67, 72? Yeah. These tight ranges that are just marching lower over time.
Yeah.
And with that,
yeah. So
go ahead,
on the Cushing front, I think one of the interesting pieces of commentary is the ad valorem tax, and maybe why the where Cushing is seasonally could be more important now, because they're the low inventories, while we have this ad valorem tax, would seasonally see those crude inventories at Cushing increase. We haven't quite seen that yet. Do you have any thoughts on?
Well, I guess one is the state of Oklahoma does not charge an ad valorem tax the way the state of Texas does. So getting taxed on something that you're holding, so do you just move it? I don't think it really, and I'll give Moet Aurora, one of my colleagues, credit for reminding me of that earlier this week, credit where credit is due, The Cushing inventory levels, it's not really a change necessarily from where it's been tracking now for, I don't know, a couple of months. Here, let me take a quick look. Cushing stocks have been near or below 5-year mins since early September. So I would say the takeaway more than any ad valorem issues is the fact that we're just not building seasonally. And so like to your point there, like, well, if it's not growing like it normally does, is that just the avoidance of ad valorem tax issues?
Well, usually I guess the ad valorem would have Texas barrels going up there. Yeah. Yeah.
Yeah. So, right. If Texas says, if somebody in Texas says, hey, I got to move this off my books, you take it. I think to me, what it like really highlights is, where could you move it? Texas oil barrel. Well, if I'm trying to avoid ad valorem tax issues, I can send it to somebody else in the world. I can send it to somebody in Oklahoma, or I own capacity and I can put it in storage. And it's not really, neither is occurring. Imports are essentially maxed out and we're not seeing any, increases in Cushing inventory, which then I think raises a bigger question. Like, it seems to square with what is in some ways been a little bit hard to reconcile over the past 11 months, being flat U.S. crude production. And so maybe the signal there is production really is flat. There's nothing extra.
Yeah. And I think, the final point on where this is also interesting, where this could be shaping up with, bearish demand, if demand changes and you have low crude inventories, is where the spec community is positioning wise. And, just looking back at the data, CFTC data from last Friday, we have WTI spec length at the 10-year second percentile. You have Brent at the 19th percentile. NYMEX diesel you got at the 11th percentile. You have gas oil at the 10th percentile. And then the one outlier that we have in the crude complex is where the specs are for their RBOB length. And that's the only one at above the median at the 72nd percentile. So I think for, WTI and Brent, that's really an interesting one when you have crude inventories quite low. I think the RBOB outlier is pretty interesting. I don't know if you have any thoughts on why the specs are seeing some bullish.
Any comments I have would be pretty see-through if anybody pays attention, because it doesn't make any sense to me. So I'm not going to try to make sense of it. I think it is important to point out the asymmetry between how the market's positioned and diesel or gasoline here, and then, diesel and gas oil, the U.S. and European equivalents kind of in the same ballpark. I think gasoline really since late last year, whether it be spec positioning or inventory levels, when it doesn't make sense, wait for it and it's about to change. I do not, I cannot make any sense of why the market would be so long.
Yeah. Okay. And one of the things when we talk about the OPEC's inventories are also quite low, which is an interesting one because, production, you've had these production cuts going on for a while. You've had some of these producers are exporting more barrels from inventories. And this week, one of the things that came out that might kind of shift what's going on with Middle East exports and where those flows are going is what's going on with India and Russia. You have Reliance signing a 10-year, 500,000 barrel per day supply deal with Russia's Rosneft. And I think you had some interesting comments on that in the daily market updates this week.
That's a pretty fascinating one. So Reliance, private refiner, I don't know, maybe one of the top 10 global conglomerates. Reliance does a lot of stuff, not just refine. So Reliance signs this 10-year deal, 500,000 barrels a day of Russian supply. It was just at mid-year that India went and asked for permission. By that, meaning you're not going to get mad at us if we go buy some of these sanctioned Venezuelan barrels, are you? And the Biden administration says, no, please go ahead. I mean, it was a little bit of a nothing headline, Venezuelan sanctions, which came back in April in the expiration of the sanction waiver, because in our view, meaning the U.S.'s view, the Maduro government did not hold a free and fair election. And so the sanctions came back in. Does Venezuelan production change on those sanctions? Zero.
Increase.
Yeah. So, and India's got a long history of buying Venezuelan barrels. Reliance was, once the second largest buyer of Venezuelan crude. That's kind of pre-2019 sanctions. And so I think it ties back to where you started today with the standoff that seems to be increasing in potential powder keg nature between Russia and the U.S. Or you could just simply say, India got the memo before everybody else. There are going to be more sanctions with the Trump administration on Venezuela. So let me go ahead and strike my deal with my next best supplier. And, the Russian barrels typically a bit more discounted. Most of them flow into China. And so India is saying, we'll just step up and take these. I think the tenor on it to me is also really interesting. A 10-year deal. That's a pretty meaningful commitment. Yeah. I mean, I think the take is, yes, Russia can theoretically supply more of India to the Far East, which would mean that more Middle Eastern barrels are available to Europe. Probably doesn't amount to a whole lot in, what's available to who and does it flow through into pricing anywhere? I think it's more of a political signal. It's somebody saying we're more comfortable with a Russian barrel than a Venezuelan barrel. And always please note that a Venezuelan barrel might as well be a Russian barrel, because Russia has been one of the key financial backers of the Venezuelan oil producing community, or PDVSA.
Yeah, as we've talked about, just in our chats, pretty interesting rabbit hole to go down into when you're looking at the Venezuelan kind of all around the industry. You see either Russian or Iranian influence on, refining or kind of all across the board. So anybody who's interested in kind of a deep dive there, that's a good one. But on the pricing front, that kind of brings up an interesting one too, when we're talking about where Saudi OSPs came out last week and kind of the regional differences and I guess the slates and how those look too.
Yeah, I'll start. I think the headline to me for January, OSPs, a light barrel headed to Asia at 90 cents, down 80 cents month over month. More importantly, down $2.40 from where it was last January. You look at the other end of the spectrum and a heavy Saudi barrel headed to Asia did not see any month-on-month change at plus $3.80. Clearly a preference for the heavy barrel. That's typical. That is common. It's not always the case. However, when you look at, where was a Jan barrel last year, a Jan heavy barrel pointing at Asia, where was it trading? Plus $7.15 versus current at plus $3.80. So bigger haircut seasonally. Right. And then, generally down across the board, the haircuts to Europe were, fairly consistent, $1.10 reduction month on month on a barrel headed to Northwest Europe and $1.10 on a barrel headed to, I'll call it Eastern Europe. It gets posted as a European Mediterranean. And those, also sizable changes versus same month last year. Context, a barrel headed to Northwest Europe at minus $1.25 compares to plus $2.90 January of 2024.
Yeah.
So it's fascinating, right? Like the lower pricing to Europe. We just talked about how low European inventory is.
Right. And I think that that does raise an interesting question is, are those changes that in the Saudi OSPs, are those a reflection of their expectations? Or do you think that's just kind of bringing pricing in line with where people are currently transacting?
I think that's where it's transacting. Theoretically, that's what that is. That's, that's loadings for January. They get set ahead of time. People know what they've got. It's up to them to choose whether to fix the Brent leg of that or not. That's truly, I believe, where they are trading. And when you factor in the, just reality of Brent being down almost $10 a barrel. So my benchmark is down 10 and my diffs, if you will, are weaker. It squares with the idea and the narrative of demand being disappointing globally. And, something is, I guess, amiss there. I guess if we're going to summarize a lot of what we've talked about today, inventories are low and demand is weak. Those often don't get said in the same sentence. So, then what's missing in the equation? The supply side. So, barrels are flowing somewhere that, is not reported, conspiracy theory. Good luck tracking that one down. Or supply is, doing its best. We know, it's stated almost daily now what's going on with OPEC. But globally, is the supply side being rationalized to avoid a glut?
Yeah. And last night, as I was kind of thinking about what we're going to talk about today, one of those questions that just keeps coming to mind is you have these low inventories. And so one of the catalysts that would maybe kind of put the crude market into a tough position is if demand does materialize. And so, that downstream from there, you're saying, okay, where is that demand potentially going to come from? When we look at some of these different regions, what's going on in Europe, I think Europe has a strong trend towards recession if they're not already there. And so, is Europe going to be the major source of demand in 2025? To me, no.
Old.
Yeah,
it's old.
Exactly.
Negative.
So,
no way.
Okay, not Europe. Do we have maybe India? I think India, maybe. It depends kind of how the tariff situation goes on, I think, between US and Asia. But I think that relationship is generally strong. Then China, I think, is really the one to look at to say, the stimulus measures that were released in September and October of this year, those are going to take some time to bleed through into the kind of regions or the sectors that they're targeting. So looking at the property sector, can they increase the demand for new and unsold homes? They had this huge glut in capacity. And then is that going to then feed into any type of development activity that would then lead to some consumption? And, I think that there's potential there. I think that they also have been pretty active in recent weeks saying, hey, we're going to try and potentially weaken the currency to offset the effects of some of these tariffs, how that relates to buying barrels. And then, kind of the last point there is just generally easing monetary policy. I think China would have to be that surprise source of demand in 2025, maybe combined with India and kind of the rest of Southeast Asia. I don't know. Can you see any other potential?
That last one, not really. Honestly, the last one that you brought up there, well, I don't know. I've spent the better part of the last 3 years along Mexico. I'm kind of stubborn on it. Not that Mexico's going to change the game globally, but I think Mexican, skip over Central America, jump to South America. I think there actually is some potential from that collective. But yes, the leader would have to be Asia in general. The jury's certainly still out with primarily negative sentiment on China. I think it is interesting. If you just go back over, forecasts for the last several years, there has been this propensity to earmark some meaningful growth into the other Asia, depending on your source. India gets lumped into that. So whether India's in it or out of it, that, I don't know, kind of take India and draw slightly down into the right line through Southeast Asia. I think there is some potential there to get a surprise. And in some ways, and a rabbit hole we're not going to go down on this podcast, but China has actually moved a lot of its, I guess, production, if you will. They've went around and bought up quite a bit of Southeast Asia. If you travel in Indonesia or Vietnam, one of the common storylines is this debate from locals that this is great. China's coming in and buying everything, so the world looks better. Or I now just have a Chinese master and I don't own my own country anymore. So the, Chinese growth becomes harder and harder over time to define. Is it China operating in the Southeast Asian countries, or is it China in China?
Yeah, it's kind of this, refineries is an interesting one. The petrochemical industry that is now spun up in, say, Vietnam, Indonesia. I think there's quite a bit of that when you think about the tariffs and the threat of tariffs that have been either, I guess, broadcast ahead of time by any administration in the U.S., China is doing its best to navigate that as well. I think when a perfect example of that is when you're looking at the solar panel manufacturing, China gets tariffs and then moves all of their solar panel manufacturing to different Southeast Asian countries. And those countries are then able to bypass some of the tariffs and get a pretty sweet deal into the U.S., which has caused some issues with U.S. producers. So there's definitely some of these things where, as you said, if you're looking at China as in the borders of China, then maybe that's one story. But if you're looking at China as in any influenced or owned Chinese entity, then, maybe that's a different picture for 20. I think one of the just kind of final points on that is the NPC came out and said that China's oil consumption peaked in 2023 today. So it's kind of an interesting question, I guess, of how their push for this energy security. They have this major security risk with the Malacca Strait, where they're importing a lot of their barrels. It's a single bottleneck that can be disrupted by any player like the US, India, any of those. And so they have this huge incentive to have electric vehicles as their primary method of transportation, or alternative fuels like LNG for trucking, which is a very interesting rabbit hole to go down into. I think if you're just looking at industrial consumption, maybe that just extends across borders. So definitely going to be interesting to watch.
Let's stay on the theme of border crossing.
Yeah, that's perfect.
We've got another topic. Yeah. It's fun on border crossing. Yeah. I don't know. Jump ball. You can pass it back.
Yeah, I'll just kind of lay the groundwork.
On the latest between the U.S. and Canada.
So really just the tariff dialogue, I think Trump always pretty active on commenting, where these, I guess, sources of U.S. Trade deficit can come from and how good of a deal or bad of a deal that is for the U.S. And when it comes to our north and south borders, that's been pretty active in recent weeks. But yeah, one of the kind of, I guess, Ontario premier came back and said, well, if we're going to have this tariff or trade war come up, then we can just cut energy exports to you guys. And then they had some other premiers come out and offer a different perspective. So I think maybe you can add some color in there.
Yeah. Doug Ford, the premier of Ontario, he's almost become a political celebrity, comes out of a meeting with Justin Trudeau, and you just kind of assume the two of them are aligned on the topic. We're prepared to cut all energy imports into the U.S. What say you, Mr. Trump? What does that mean? Well, for the states of, Michigan and New York, most especially, but Wisconsin, a few others, it's the flow of power. We import a significant amount of power. NISO, I can't remember what the number is in the New York ISO. It's a significant number. Ironically, most of that power does not come from a fossil fuel source. It comes from hydroelectric power. However, the statement is, we will cut your energy imports, natural gas and power, if you don't back off of this 25% tariff across the board. You move to the left across Canada and you land in Alberta, one of the producing provinces, or the producing province, Alberta and BC. And Danielle Smith, the premier of Alberta, says, yeah, not us. And under no circumstances will we be cutting our flow of energy to the U.S. And then you pan out and go, all right, well, what would this mean to the U.S.? Power, local municipalities, counties, states in the Northeast would get hurt. How would that impact the overall, let's just say, U.S. economy? Sorry, I'm not picking on Wisconsin, New York, or Michigan, but the only one of those three really that has any significant industrial output is Michigan. And so, what's the net effect? A lot of yelling and screaming, and the losers are the local consumers, the households, probably not big for the voter base. And then when you think about the flow of Albertan energy, that's oil will come into the U.S. How much Canadian oil does the U.S. rely on? Well, 20% of our refinery input comes from Canada. That would be a big impact. But if Alberta is not going to participate in this mudslinging, then does it really change anything, or is it just a bunch of headlines? I would say more the latter. However, it is, as the days and weeks pass, as we march forward to Inauguration Day, And, everybody's seen plenty of the videos and pictures of the famous sit down and start signing all the executive orders. Get out your fancy pen on your nice leather pad. Do any of those have language in them related to Canada and tariffs? Probably important, but more so for the household or the small business than for overall U.S. industrial activity. That's my take on it.
Yeah, and I think that distinction is pretty important because, when you see the headlines about the Ontario Premier's comments, the immediate jump is to those crude flows. But as you mentioned, that's really the Alberta side of it. And I think that that's maybe getting blown out of proportion. And when I'm looking at the interchange right now, so U.S. imports of power from Canada for kind of the last 30 days, you have at peak about 4.3 gigawatts of imports from Canada. And just for context, over that same period, you have lower 48 load at over 515 gigawatts. So, it's something, but it's not massive. So
wind in Texas can miss forecast by that much. This creates a little ripple in the daily market, but it's not a whole lot.
Yeah, and I think that the power / natural gas is maybe a good opportunity to jump into this week's EIA storage report, because I think that was an interesting one, how market reacted to something that kind of beat expectations. And we had an interesting chat just before we hopped on here too about that.
Yeah, let's start talking about expectations. We'll harken back to earlier in this podcast and point out the expectations for 2024 oil demand. Well, shouldn't that be mostly a thing of the past? No, we just change our expectations of what happened in the past. So moving over to natural gas. Interesting thing with this week's storage number, the December 5th EIA reference week. So Monday, Tuesday, expectations get finalized, crystallized at around 173 BCF withdrawal, let's say. And 173 BCF, how does that compare to what the market was expecting for that same storage week with weather already in the forecast, say 7 to 10 days prior? Most expectations were around 150 to 160 BCF. So my expectation was here. I moved that 10 to 20 BCF tighter, and then the number comes out, minus 190 BCF. Well, that was more than my expectations. By a lot, 3 BCF a day. And if I go back not too far in the time machine, measuring in days, it's as much as 40 BCF greater than one predicted. And it's not to say that there wasn't a rally on this. It's a little bit difficult to pick apart. So you go back to December 3rd, and really December 3rd, December 4th. So call it middle of last week. The January NYMEX contract intraday made a dip below $3, and as of yesterday made a momentary move over $3.50. So was that all on the 190? No, because before the number came out, the market was already trading 335, and we're back below that level now. So the first 35 cents was on, I believe, the volatility and weather model output that was suggesting that we weren't flipping from, one cold week there that we just did 190 BCF withdrawal on to a locked in warm pattern for the rest of the winter. It was maybe there's some weather uncertainty out there. Maybe we don't need to be priced this low. So that last, let's just call it, 20 cents up to the one touch highs was on the storage number. And now we've given most of that up already. So pause for a moment, reflect a little bit more on this 190 BCF withdrawal. You got to go back to 2009 to find a fifth week of withdrawal season that had a greater withdrawal. And then historically speaking, what was how far do you go back to find similar weather? Because that was a very cold week at over 200 degree days or HDDs. That was some significant cold. It wasn't like this is just this eye-popping, weather-adjusted bullish number. Well, actually, it was pretty eye-popping, but not as significant as the fact that we withdrew 190 BCF last week, and the same week the year prior we withdrew 72. So Going back in the time machine, you get all the way to 2005 to find a similar weather week. And then there's another one in 2002. So those weeks, similar weather, one of those, 2002, you took out 162 BCF. 2005, you took out 202. Caveman approach, add them together, divide by 2. That's a 182 BCF withdrawal on similar weather. So why does that matter? Well, if we have all of this supply, clearly there's been extraordinary supply growth from the early 2000s. It's not even really worth talking about. It's just such different eras. But I think the simple observation there is, well, clearly demand has grown too. We're not taking out anything less on that kind of meaningful cold than we were, early in the 2000s. I think looking forward, what becomes critical over the next couple of weeks, which are much milder, is whether or not we see withdrawals in, call it the 110, 120 range. Between 110 and 120 withdrawn in each of the next 2 reporting periods, you would have your year-over-year storage surplus quickly approach 0, small single digits. I guess for point of reference here, the current year-over-year storage surplus is down to 67 BCF. It was 185 last week. So clearly that's a big shift. And at 100 and let's just say 15 or so, you're near 0 on the year-over-year surplus. And with weather uncertainty out there, that would say weather-adjusted S&D is flat year-over-year. And what do I think about the rest of this winter? Well, if it just looks like I'm going to get a hodgepodge flipping back and forth, what else can I assume other than normal? Seasonal forecasts are still significantly warmer than normal. As a reminder, the month of December was supposed to be significantly warmer than normal as well. And presently, it's going to be much closer to normal than originally predicted. So seasonal forecast for January, smoke out. Well, why do I trust that? You said the same thing about December. So normal weather adjusted S&D and normal weather equals an end of March at sub 1.7. Let's just call it, 1.65, 1.7. And that is meaningfully lower than the level that the market's hanging on to, which is around a 1.9. Many were over 2 TCF for end of winter before the winter began. Also important reference points. If the market's 1.8 to 2 TCF before the winter begins, and then yes, there was one cold week in there and we took out a 190, but overall it's been warmer than normal. If the end of season estimates, are having this gravitational pull lower without the effect of weather, I think there's a very clear signal there. I mean, it's been in place for the last 2 seasons. We are undersupplied on a weather adjusted basis, and yet it's been mild. So here we are. No, we're not out of the woods yet. And I think you've seen some recovery at the front of the curve for sure. And there's plenty more to go if weather is normal.
Yeah.
Maybe if.
Yeah, and I think at some point, as we mentioned in our earlier chat, just how that is maybe affecting some of the Jan, Feb, March. I think we can dig into that at another time, but we'll take kind of a similar look over at Europe. And maybe if you can just kind of give a high level of what TTF, JKM has been doing in the last little bit here.
Yeah, Alex, thanks. Last week, you did a great job covering the European gas storage situation where it was a kind of a rapid drawdown. That has slowed. But the other thing that we talked about was the really difficult to rationalize parity between TTF and JKM. And sometimes when something seems odd and doesn't make sense, wait 5 minutes and it changes. And lo and behold, the spread between TTF and JKM has widened back out. It is near $2, and that is 100% TTF coming off. JKM still near $15 at the front of the curve. TTF 13 and change, call it 13 and a dime. So gas market in Europe is seeing a backpedaling, and then I'm going to kick it back to you because I think there was even more interesting news and a more micro scale in the power market.
Yeah. So, as you mentioned, temps warm up a bit, but one of the interesting ones this week was specifically for Germany, really. You have the second round of Dunkelflaut, the dark and calm, dark, calm conditions that then cut wind and solar. And so I guess it was December 10th, so Tuesday, and December 11th, Wednesday, you have German onshore wind fall by about 85% day over day. And then for the next 2 weeks, you have an average of about 70% cloud coverage over Germany's solar producing regions. And so just kind of that concentrated impact of of wind generation just collapsing. You have power prices react, and day ahead auction heading into Wednesday, which is what we were writing about this week, hit a month-to-day high. So, somewhere I think is around 445 euros a megawatt hour for the day ahead auction. And then on Wednesday, you get power prices reach over $1,000 megawatt hour, which highest since energy crisis. But then kind of what we were talking about before this call was last Friday, you had power prices kind of dip down to $76 a euro megawatt hour, and then jump to 240 euros a megawatt hour for an average.
Actually, it was up to 40. Up to 40.
Correct. Yeah, thanks. To 320.
Yeah. This is a
massive jump. And really, I think the takeaway for all of that is just the volatility. And I'll put this in the chart deck because I think it's a pretty interesting visual, is just the heat maps for the different generation as you get this seasonality in Germany's resource mix. So kind of as you head into winter, solar for Germany is quite useless. It comes off, you get pretty much dark conditions for extended period of time. So then you're relying more on volatile wind output, which these heat maps are quite, I guess, symbolic of what's going on there. And then the really interesting takeaway is when we had this early November Dunkelflaut, this was kind of an extended Dunkelflaut. And you can just notice that gap and what that does for thermal generation resources, natural gas, hard coal, lignite. And then it, comes off, Dunkelflaut goes away, you get wind generation again. And then come to this week, you get the same thing. And so I think that, really that's kind of the takeaway there. Just kind of an interesting storyline, and just to expect more volatility. I think that's having just a underappreciated impact on Germany's industrial activity and economic situation right now. And hopefully that gets resolved, because when you listen to, I guess, anecdotal boots on the ground feedback from consumers and businesses, they really want to get to a point where they can continue to be the economic center of Europe. But from a policy perspective, there's quite a bit of turmoil still to figure out, and definitely want to watch. Fits into the Crude picture too. So yeah, definitely be one that we are keeping track of. And with that, I think that gives us enough to digest for one day.
I mean, I love these. We start and we're like, oh yeah, we just got a few things to talk about. 50 minutes later, wow, that was a lot.
Covered all over the world. Yeah.
Encourage anybody that's listening that's got any further questions. Alex mentioned earlier that, I guess we both use the term rabbit hole. If you would like to go down with any of these rabbit holes with us personally, we are available. Give us a call, shoot us an email.
Yeah, and check out the chart deck and the show notes. And yeah, Zane, I'll see you again, I guess, a week from now. All right.
Sounds good.
Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts, or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.